How's it, everyone? Thanks for tuning in. My name is Ian Culley, and I'm bringing you your Friday edition of What the FICC. This is a spot where we bring you all the latest information on the fixed income, commodity, and currency markets. Spencer Israel is out today, so I'm flying solo. We have a lot to talk about. So let's go ahead and jump into the charts. First up, I just want to run through broad market recap. Go over gold, crude, copper, hit on some treasuries, and then wrap it up with a little bit of the US dollar. So first up, gold futures. Precious metals have started to pull back in the past couple sessions since Wednesday. I'm going to get more about that later in the show. But gold still struggling with that overhead supply around 2,089, those former all-time highs from 2020. And notice that we got a bearish divergence in momentum, kind of gives a heads up that the bulls were losing control or losing momentum of in the uptrend. So I'm still keeping my eye on that 1980 level, the pivot lows from last month. Gold futures back below 1980. We could see a much deeper correction in gold. GLD, the level is 185. That coincides with the prior cycle highs around 2011, from 2011, excuse me. As long as GLD is above those former highs, the path of least resistance is higher. I got to give GLD the benefit of the doubt. On the flip side, GLD back below 185, all bets off. Now, the miners really impressed last week with the successful retest of this former resistance level around $33. Now, GDX is right back at that level today. Will it hold? That's the big question. GDX, the bulls need to step in, and they need to step in now and support that 33 level. GDX back below 33. And again, I imagine that we're getting a much deeper correction, much like gold below 1980. And a lot of those mining stocks that have held their breakouts and have recently hit our upside objectives, our initial targets, most likely pulling back. And the ones that haven't could see some failed breakouts in the mining space. GDX below 33. Something to keep in mind. Now turn our attention to crude oil. Crude's hanging in there. It's holding above the shelf of former highs going back to 2019. That level, that former resistance level became support in 2021 and 2022 and earlier this year, and remains support so far. Potential support now, as long as crude oil futures are trading above 65, got to give crude oil the benefit of the doubt, got to give energy stocks the benefit of the doubt. A big wick as we zoom in here last week. This really had my attention. Bears drove prices below that 65 level. And this is what stepping in and repairing the damage in a timely fashion looks like. A wick like this. And what did we see? This failed breakdown. Strong upside follow through. Now that 74 handle is just out of reach. If and when the bulls can reclaim that 74 handle, I think we could be catching back up towards the upper bounds of this near-term range around 83 bucks. Looking at the US oil ETF, USO, the level's 58.50. Now, if and when USO is below that level, then the bears are likely in control. Crude oil is probably back down around 65, maybe below. As of now, it's trading in the low 60s. Got to give USO, got to give energy, got to give oil benefit of the doubt. Now, copper, big moves in copper yesterday. Copper breaking down from this short term, this consolidation. It almost looked like a falling wedge here. I wouldn't call it a bull flag. It's a little too long in terms of time frame for a bull flag. Regardless, a consolidation breaking down, not in the direction of the underlying trend, but reversing lower. But as long as as long as copper futures are holding above this 330 level, is marked by the prior cycle peak, 2018, got to give copper, got to give base metals the benefit of the doubt. Zooming in, we see that breakdown. Remember, between 380 and this $4 level, it's just messy. Remember, these two key prior pivot highs. September pivot high, the early September pivot high. Remember, back down here later that month is when the dollar peaked. Copper rallied as the dollar weakened. Now the dollar's kind of chopping sideways, picked up a little bit of strength yesterday, caught higher. The dollar bid yesterday as risk-off tone captured or the market. Copper futures rolled over. So as long as copper's below 380, the bias, my bias is lower, back towards that 330 level, back towards those prior cycle highs in 2018. So if we got copper in mind, Freeport-McMoRan went over last week how closely correlated, the positive correlation between FCX and copper futures is almost as strong as it can get. Level in Freeport-McMoRan, 33. Below 33, risks are to the downside. Copper's likely retesting that 330 level. And base metals in general, pro-cyclical commodities in general, cyclical stocks in general are probably coming under increased selling pressure. Keep an eye on FCX. It's an important one. One of the most important cyclical bellwethers out there. Now, getting to rates, not a lot has changed. It was interesting to see bonds bid yesterday morning as all risk assets seem to come over under selling pressure. So I think that's a good sign just for the bond market to actually catch a bit of a risk off bid. That's something that did not experience last year, an historic sell-off in bonds and treasuries. Nevertheless, it's still a sideways mess near term. Still chopping sideways. Will rates roll over? I think it's a big question. And we're not really getting anywhere because the market really can't decide what the Fed's next move will be. And I'll get to that later in the show. TLT mentioned earlier in the week on Wednesday. Today was Thursday. TLT was carving out a solid looking base. Momentum is in the process of just improving. It's pounding this resistance level around 110. It hasn't made a move yet, while growth versus value continues to print fresh highs. So growth stocks, large cap growth, those big tech names are outperforming value cyclical areas of the market. Makes sense when you have copper breaking down and Freeport-McMoRan on the verge of breaking down. Will we see rates roll over? That's a big question. US dollar says no, not yet. It's digging in. It caught higher, just around 102 yesterday. We're continuing to see that strength play out this morning. And when we look, beyond the 6 components of the US dollar index, at our G10 currency index, and at our US dollar AD line, comprised of 29 dollar pairs, we're not seeing fresh lows. We're not seeing the same type of weakness we're seeing at the US dollar index level. So to get a decisive breakdown with conviction, I want to see these other lines follow lower. I'm just not there yet. UUP, the US dollar index fund ETF, the level is 27, 27 and a quarter. Again, UUP turning higher. And again, check out the bottom. It has not hit oversold conditions. Dollar index never hit oversold condition. That's a 14-day RSI reading below 30. Never got it. Technically, US dollar index is still in a bullish regime. Bears need to take control of the market if we're going to have a weaker dollar and a nice, stiff, strong tailwind for risk assets, especially stocks. All right, now I'm going to switch over to a few of my favorite charts. Try to bring 3 charts every Wednesday and Friday, 3 charts that are at the top of my list, that are really top of mind. Somehow those 3 charts turned into 7 today, so bear with me. But number one's got to be silver. right? The 24.75 level, that was my line in the sand, not only for silver, but for precious metals. And the reason is silver's the crazy cousin. It's the high beta play of the precious metal space. So to see silver break down, have it down almost 5% yesterday, that's not uncommon to see a big move. But to see the strong risk off associated with a strong downside move in silver, especially below this polarity zone that acted as support last spring, became resistance towards the end of last year and earlier this year, and then became support again last month. So to see silver back below this 24.75 level, risks are to the downside. I know it hit a 23 handle earlier this morning. I think it's trying to dig in and bounce higher. Let's see here, silver futures. Silver futures are trading around 24.07 right now. And that is the July contract. So well below my risk level. With silver back below this level, it's I gotta imagine that gold, GLD, gold futures retesting that 1980 level, and GDX most likely follows through, breaking back into the box here below 33. That's if the bulls don't step in and repair the damage like we witnessed in crude oil. So far, that's not the case. Time's running out. Bulls need to step in and they need to drive prices higher. Now, SLV, the level in SLV is 2250. I always like to bring it back to the ETFs and stocks when I can. And the reason, again, is silver is the high beta play. And look at the silver gold ratio. Basically high beta, low vol. Now look at the silver gold ratio. Running into a level that has acted as support in the past, now it's resistance and turning lower. Now in the past, that has resulted in a pullback in gold. As you can see earlier this year, as gold futures caught higher, silver gold ratio was rolling over. Eventually, gold pulled back into last month, or excuse me, March. Now, gold catching higher, silver gold ratio followed, but now with the silver gold ratio rolling over, risk-seeking behavior is waning, risk aversion is starting to show itself when it comes to the precious metal space. I imagine it hits gold eventually, and we see gold roll over. Second chart I wanted to bring today, kind of along the same lines, has a lot to do with copper, has a lot to do with gold, just the metals in general. Just the metal space is starting to roll over, seeing a lot of weakness with the dollar strength. Makes sense. But to see the base metal complex, base and industrial metals, continue to catch lower relative to precious metals. This is the ratio chart between our custom base metal index or equal weight index and our custom precious metal equal weight index, printing fresh 2-year lows. This is not the type of scenario that supports a broad rally in commodities or cyclical assets. This isn't what we tend to see when Freeport-McMoRan is pressing towards new highs. This makes sense when Freeport-McMoRan and other cyclical stocks are on the verge of breaking down. But again, bulls need to step in. We need to see some support here for base and industrial metals in the near future. This also kind of speaks to the copper gold ratio. This is just a broader look at the copper gold ratio. When we look at the copper versus gold, also printing fresh 2-year lows. So what does that mean for yields? It's got to mean lower yields, but you've seen a lot of divergences between these two charts over the past 2 years. So we'll wait for confirmation here in yields. We can just chalk the copper gold ratio and base just versus precious metals as 2 more charts supporting or suggesting, I should say, lower yields. All right, third chart today, the euro. And this has a lot to do with the dollar index, because the euro is over 50% of the US dollar index, DXY. So as the dollar index starts to catch higher, it's probably happening with the euro rolling over. And that's exactly what's happened in the past couple sessions. The euro breaking down, pulling back, not necessarily breaking down, pulling back after printing fresh 52-week highs recently, back down towards that 108 level. That's been my line in the sand for months. I've written an article a few months ago, basically stating if the euro is above 108, it's going to be really difficult for the US dollar to rally, the DXY to rally. And that's been the case. Now, on the flip side, if the euro loses that 108 level and it starts trending back towards the pivot lows from March, or even back towards parity last fall, we're likely going to see the dollar index above 105. Now, why do we care about that? We've been joking and throwing it around, internally, below 105, buy stocks. The dollar index is trading below the 105 level. Risk assets deserve the benefit of the doubt. The problem, it might be messy. It might be messy, but risk assets are probably doing well. Dollar index above 105, that's no longer the case. So keeping an eye on the euro, keeping an eye on that 108 level and further weakness, because further weakness in the euro, we likely see that dollar index back above this 105 level. That would not be good for risk assets, stocks, commodities alike, and certainly not for silver and precious metals. All right, moving on to the sleeper. I always like to bring a chart of a stock that I don't know if everybody's, if it's on their radar. Some of those charts, sometimes I even can't believe it when I see it. Today, I want to share with you the breakaway dry bulk shipping ETF, BDRY. It had an amazing run off of the 2020 lows into that late 2021 peak, when you had all the supply chain issues, the rising inflation, you had all the ships, docked off of the LA port, ripping, absolutely ripping. But it has retraced quite a bit since. But over the past year, 10 months or so, it's been carving out a tradable low, challenging this 1050 level 1, 2, 3 times. And the more times the level is tested, the higher the likelihood it is to break. So I like trading against that 1050 level, getting long BDRY if and when it takes that level out with an initial target up around 2220. I mean, that's a double. Trading a breakaway dry bulk shipping ETF. I love this trade. And when you look at momentum on the lower pane here, it just hit overbought, which I love seeing that. And I've talked about it before in the past. I like seeing the bulls show that they're taking control of the market, even if it doesn't coincide with that initial breakout. Now it's holding in there. We're still in a bullish regime, and momentum has been improving since last July. So keep BDRY on the sheets. Keep BDRY on your radar. Above 1050, I like it long again with initial target up around 22. All right, to close things out today, I don't really have a big deep dive, but I've noticed, we look at the dollar, we look at rates, and not a whole lot has changed. Not a whole lot has changed. You're still chopping sideways. I still think we're in an environment where it's all about the dollar. It's all about rates. S&P 500 still chopping below that 4,200 level. Commodity indexes, the CRB, our equal weight commodity index still holding above support. Really haven't seen any decisive breakdowns. What was really interesting over the past week, you had to see a definite shift in the way investors are anticipating the Fed's next move. Last week, after the Fed hiked 25 basis points, they signaled that they're, a very strong a probability of a pause in June next month. These are what the probabilities were on the 4th, May 4th, based on the Fed funds futures. So you had about 91.1% here that the Fed's going to pause. Not going to do anything. Wait and see. Let more economic data come in. Another CPI, another PPI, another NFP, another housing this, housing that. I don't know, but they're going to wait. They want to pause. At least that's what they were signaling, and that's what the market was anticipating last week, with an almost 10% chance they might even cut next month. Fast forward to today, no chance of a cut, no chance of a cut. Similar probability of a pause, but it's flipped. Now there's a 13% chance that next month the Fed might actually raise another 25 basis points. And I think that shift in attitude it speaks to the risk off tone that we've seen in the past 2 days. It continues to play out today. I mean, crude's down, the breakout in cocoa's failing. It's a lot of red out there. So I just wanted to share that. That's just on top of my mind. One of the few things that I've really noticed shift in the past week or so. Because I mean, when you look at these charts, and when are yields going to roll over? What's going on? What's the dollar? Is the dollar going to break down? No, but things are definitely changing. Definitely seeing a flip in investor attitudes and what the probabilities of the Fed's next decision regarding rates. That's it. That's all I have for today. Thanks for tuning in. Spencer Israel will be back with us next week. You can find all my research at allstarcharts.com. Head on over there. Check it out. Better yet, just reach out at info@allstarcharts.com. Say, hey, let me know what you're looking at. Tell me what you think about the BDRY. What you think about the breakaway dry bulk ETF. And, have a great weekend. I think the best trade for today on this choppy, frustrating intraday action is to just step outside, enjoy the fresh air, spring. Let's get out and have fun. Have a great weekend, everybody. And thanks for watching. I'll see you next week.